As the demand increases within the organizations for financial professionals to possess more analytical and problem solving skills, an increasing number of people are earning managerial accounting credential. So, if you are someone who is crucial to know what is management accounting, this is the right video. So, in this video, we will be discussing about management accounting and what is the kind of role, and also we will be differentiating the different accounting types as well. So, without any further delay, I am Edwin Thomas and let's get started with the video on Introduction to Management Accounting. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out any new updates or video releases from Great Learning. If you enjoy this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any queries or suggestions, and I will respond to your comments. Management accounting is the provision of financial and non financial decision making information to the managers. In management accounting or managerial accounting, managers use the provisions of accounting informations to inform themselves better before they decide matters within their organization, which allows them to manage better and perform and control functions more efficiently. Now, with that note, I am Edwin Thomas, and let's get started with the course on Introduction to Management Accounting. Now, let's talk about the topics that we are going to cover in today's course. So, before we directly jump into our main topic, that is management accounting, we'll have first a small discussion on the basics of accounting. Under this topic, we'll be discussing the accounting process and the five elements of financial statements. So, by understanding and clearly learning about these topics, you will have a firm grip on the basics of accounting and you can easily segue into our main topic, that is management accounting. Now, under the topic of what is management accounting, we will be discussing the definition of management accounting and also understand what is management accounting. Then, to make things even more clear, we have the next topic, that is characteristics or the nature of management accounting, where you will have even more clear idea of what management accounting is. Now, if you want to pursue a career in management accounting, you will actually want to know what kinds of shoes you're going into, right? So for that, for making that clear, we have the role of management accountant, that is the next topic, where we'll be actually making you clear what kinds of roles and responsibilities will be given to you if you are going to enter into a company as a management accountant. The next two topics is the difference between management and financial accounting and the difference between management accounting and cost accounting. So there are a lot of confusion between like financial accounting, cost accounting, and management accounting is the same thing. What is the big difference? So these two topics are going to bust the confusions that are coming across between these three domains. So we'll be differentiating between management accounting, financial accounting, and cost accounting individually. Then, to conclude things, we have taken a real-time example of a management accountant working in a manufacturing company and what kind of role was he assigned to by the upper management and how does he resolve it. So that is the way we are going to conclude this course. Hope you guys are going to stay till the end of the course to understand what is the kind of roles and responsibilities of management accounting. All right, guys. So now, before we enter into our major topic, that is management accounting, let's brush up our fundamentals, that is the fundamentals on basics of accounting. Now, accounting is basically summarizing financial data into a meaningful format. Now, every company has a huge amount of financial data that is getting generated on a daily basis. For example, the bills, the vouchers, the receipts, etc. Now, in accounting, all these transactions are recorded, and not only that, these transactions are actually recorded, and management accountant actually classifies these and also summarizes these into meaningful format. Now, all these things are done actually to answer the questions about the financial stability of the company to the owners, to the shareholders, or as a matter of fact, even the government of India. So that's why accounting is so much important to a company. Now let's talk about the accounting process. Now the flow of the accounting process is on your screens. Now first comes the source document, followed by the journal entry, ledger, trial balance, and financial statements. Now the first four process is altogether known as bookkeeping. Now let's first take up source document. Now to record any financial transaction, you need to have an evidence of that transaction. So evidence can be a bill, a voucher, or an invoice, or any evidence that is pertaining to a financial transaction. So any evidence that is pertaining to a financial transaction is known as the source document. Now coming to the second process, that is journal entry. Now according to the source document, an entry is made inside the journal book. Now, a journal entry consists of the date of the transactions, the particulars like the description of the transaction, the credit column, and the debit column. Now, a financial transaction is entered inside the journal book according to the classifications. Now, coming to the third flow in the accounting process, that is ledgering. Now, let's understand what is a ledger. A ledger is a book that consists of a bunch of T accounts, and these accounts are known as T accounts because when we form a T, you can see that there is two columns that is getting formed. Now, always remember, the left side of the column is always known as the debit column and the right side is known as the credit column. Now, a ledger account or a ledger book is divided into three, that is general ledger, debitors ledger, and the creditors ledger. Now, a general ledger consists of an overall sales figure, and a debtors ledger is known as the T accounts for the customers. Now, for example, Rohan is your customer. He buys goods from you on a credit basis. So basically, he buys goods from you and does not pay, and he says that he will be paying in the future. That is what is known as credit basis. Now, understand that since Rohit actually owes monies to the company, the account goes to the debitors account. So T account is made in the name of Rohan. So now if your official goes and buys something from your suppliers and buys the goods on a credit basis, that is, you take the goods but does not pay the company now, but you promise to pay them in the future. So that is known as credit basis. Now, but you owe you as a company owe the suppliers the money. So these kind of transaction goes into the creditors account. So that's why it is known as T accounts for the suppliers. So now you have understood the ledger are divided into general ledger, the debitors ledgers, and creditors ledger. Now, ledger is the place where all the individual transaction is getting summarized. Okay, so now a journal book actually has a ton loads of transactions that is coming on a daily basis from our customers and also the suppliers. Now think of a situation like if your manager comes to you and asks you how much money do we owe Rohit's company for their dues. So now, and when your manager asks you this, you can't just go to your journal books and search for the transactions that Rohit's company made because Rohit's company might have made transaction on 15th of August, 20th of August, 24th of August on different various dates. Now you can't go sit there with the journal book, gather all the transaction on a daily basis, and then start calculating and then understand how much money do we owe them. So instead of that's where ledger actually comes into play. So when you actually add a transaction into a journal book, there are T accounts on Rohit's name already. So when a transaction is entered into the journal book, it is also getting transferred to the ledger. Now this process of transferring the debit and credit to the ledger is known as posting. Okay, so that's the technical term that is used for the transfer process from a journal entry to a ledger. Now, as we are actually transferring this data, you actually get a proper one figure for the transaction of a T account in the name of Rohit. So the next time when your manager comes to you and asks you how much money do we owe them or how much money do they have to pay us, you will always have one figure that is 50,000 or 5 lakhs that they owe us or we have to pay them. So that's why ledger is so very important to actually answer the direct questions that comes to you. Now, after we are done with the ledger accounts, we move ahead with the trial balances. Now, trial balances basically is to balance all the general ledger account of a company in a certain point of time, mostly in the end of the year. Now, the basic objective of a trial balance is to summarize the ledger accounts. The second major objective of the trial balance is to create a base for the financial statements. Now, as I mentioned earlier, the four processes, that is the source document, journal entry, ledger, and trial balances, are all together known as bookkeeping. Now, after the process of bookkeeping is done, is when where we move ahead with the financial statements. So the financial statements are divided into three, that is balance sheet account, profit and loss account, trading account. So now that's the entire process of accounting process. Now I believe that you have understood the flow of process of accounting. Now let's move ahead with the next topic. So next up we have the five elements of financial statements, that are expense, assets, liability, equity, and revenue. Now let's understand each of them individually with their definitions. Now coming to assets. Assets is a resource controlled by an entity. Now, what do you mean by control? Control is like an ownership. An entity can be a single person or an organization. So, asset is a resource controlled by an entity as a result of past events and from which future economic benefit is expected to flow to the entity or the organization. So, what do you mean by future economic benefits? Now, for example, you have a manufacturing company and you bought a machinery. Now, that machinery is an asset because that machinery is going to actually provide you with future economic benefits because it's going to provide the raw material to convert into finished goods, right? So, that is exactly how an asset is defined. Now, coming to expense. An expense is the cost of operations that a company incurs to generate revenue from which no further benefit is expected. Now, difference between an asset and expense is that in asset there is future economic benefit, but in an expense there is no future economic benefit. Now, an example of an expense is like the rent that you're paying for the stall or the shop, or the electricity that you're paying, or the salaries that you're paying to your employees. So that is the kind of expense which will not have a future economic benefit. Now, coming to the next point, that is liability. A present obligation of the entity to transfer an economic resource as a result of a past event. It is a claim of an outsider on the total asset of the company. Now, for example, if you have a big loan that you have taken from a bank, that's actually acting as a liability because you have to repay it. That's why it's called as is the claim of outsiders on the total asset of the company. Now, coming to the next point, that is equity. Now, equity can also be known as capital. So, according to the organization, if it's a partnership organization where there are few owners, it's known as capital that has been put by the owners. If it's a capital put by a number of people like A, B, C, D, A is capital, B is capital, C is capital, and D is capital. But when it's a company, it becomes equity because the company has a lot of owners that is in the name of shareholders. So that's why it's known as equity. But the definition of both capital and equity is going to be same. Now, it is the residual interest in total asset of the entity after deducting all its liabilities, and it is the claim of the owners in the total assets. So now equity is the residual interest, that is after the payment of the liabilities, the residual interest is known as the equity, and it is the claim of the owners, as I mentioned earlier, the owners or the shareholders. Now, revenue. Revenue, it is the gross inflow of cash, receivables, or other considerations arising in the course of ordinary activities of business, such as the sale of good, rendering of services, etc. In simple words, if I had to say what is revenue, it's income. So that's the easiest and the most simple word to explain revenue. Now, with that, we have completed the basics of accounting, and let's move ahead with our craziest goal, that is management accounting. All right, guys. So now that we have covered the basics of accounting, now let's move to our major topic, that is what is management accounting? Now, management accounting has various definitions given by the Chartered Institute of London, Chartered Institute of England and Wales, and many other professors. Now, let us stick to the definition that was given by the Institute of Chartered Accountants of India, that is ICAI, and that goes by the techniques and procedures by which accounting mainly seeks to aid the management collectively in making decisions have come to be known as management accounting. Now, after reading the definition, you might have understood that management accounting is done to help the upper management in making decisions of the future by formulating plans and growth options by using quantitative and qualitative analysis. So that's what is management accounting for you. So now to understand management accounting even more clearly, let's move ahead with the next topic, that is characteristics or nature of management accounting. Now here, the first point we have, management accounting is a technique of selective nature. Now, why is management accounting known as a technique of selective nature? That's because in management accounting, the accountant does not require all the data that is provided in a financial record. Now, in a financial record, it might contain the financial statements, the balance sheets, the profit and loss statement, the cash flow statement, the income statements, and a lot more information. So, for example, a management accountant only requires the balance sheet and the profit and loss statements to actually do his quantitative and qualitative analysis and actually provide a report to the upper management. And so, due to this selective nature of management accounting, that using only these two statements to arrive at a conclusion, that's why the technique is known as selective in nature. Now, coming to the second point, that is management accounting is concerned with the future. Now, every company in the start actually accomplishes some goals, and then it always actually thinks about what is the future of the company, what are the future plans that could actually impact the company's growth. Now, here's where management accounting actually helps. So, management accounting actually does the analysis and helps the upper management takes a decision because of its quantitative and qualitative analysis. It can actually forecast the different options that the company can go further. So, the different options and with their liabilities and their debts and their profit benefits, all these kinds of information are given to the upper management in the form of a report, which helps the upper management to actually go ahead and choose the right decision for the company's growth. And this is why management accountant is concerned with the future. Now, coming to the third point, that is management accounting makes available useful information. So now, by hearing the term management, you might be in a confusion that management accountant might be into the level of decision making, but that is not the exact concept. So, management accounting basically only provides the necessary information to the upper management to make the decision making. The decision making is entirely up to the upper body or the upper management, and only the information or the report that is provided by the management accountant is actually used for the decision making process. So a management accountant is not actually the person who takes up the decision, it is the upper management who is takes up the decision about the company's future. So that's one thing that you have to make it very clear. Now, coming to the fourth point, that is management accounting attempts to study the cause and effect. Now, in financial accounting, they basically deal with the analysis of the profit and loss statements. Now, in management accounting, they try to or attempt to study the cause and effect relationship that actually impacts the profit and the profitability of the business. Now, coming to the fifth point, that is management accounting is no bound by rules of financial accounting. Now, unlike cost accounting or financial accounting, they are actually bounded by rules that is provided by ICAI, that is Institute of Chartered Accountants of India. So unlike these two, management accounting is not bound by legal rules. Management accountants are just have to follow the company policies they are working with, and they have to follow the instructions that is given by the upper management. So that is the fifth point that explains you management accountant is no bound by the rules of financial accounting. So if you want to pursue a career in management accounting, you would always be curious to know what is the kind of role or what is the kind of responsibility that you will have on yourself as a management accountant of a company, right? So that's exactly what we are going to discuss here. Now, here we are going to discuss what are the kinds of roles that, as a management accountant of a company, you will have to work upon. So, these are the points or the roles that given below, which you will be working on maximum amount of time at that company by doing the following things. So, the first point that is mentioned here is the collection of information. So, as a management accountant, he collects the essential data that is from a financial record to formulate his plans and policies to the management. So basically, as we already discussed, in a financial record, there are a lot of statements that like the profit or loss statement, the income statement, the balance sheet, etc. So the as a management accountant, he only chooses the relevant information and collects it, and then formulates a plan accordingly to the management. So that's the first step that as a management accountant does. Now, coming to the second point, that is evaluation of information. So, here comes the role of evaluation, wherein the information that is collected in the first role that is getting evaluated for the best purpose, that is the usage, best usage, and easy understanding. Right? So here the management accountant becomes the judge of keeping what is relevant and what is irrelevant. So he keeps what is relevant to the report that is going to be presenting to the upper management. So that is the second point, that is evaluation of information. Now coming to the third point, that is analysis and the interpretation of data. Now, the accounting data is meaningfully analyzed, and that is for the effective planning and the decision making. Now, the data is represented in a very comparative form, that is, the ratios are calculated and the effective likely trends are projected to the upper management. Now, coming to the fourth point, that is planning and organizing. A management accountant assists the management in planning as well as formulating policies. Now, this is done by forecasting the production, selling, inflow, and outflow of cash. Now, a management accountant also shows the alternate course of action and forecasts this also. Now, coming to organizing, a management accountant organizes by preparing the budget and delegates the responsibility for the proper utilization. That's how the management accountant has the role of planning and organizing. Now, coming to the next role, that is reporting. Now, reporting is one of the main role of a management accountant because he has to report everything that he has found, that is his analysis, the data, the plan, the policies that he has formulated. He should be actually representing these all data that he has found in a very structured and clear manner and an articulate manner to the upper management so that it can be easily understood and easily read by the upper management to make their important decisions for the company in the future plans. So reporting is actually a very important role for a management accountant, and he has to do this reporting as perfectly as possible. Now, coming to the last point, that is coordination and decision making. Now, a management accountant helps the management in coordination with the enterprise by preparing the budget and forecasting the future plan and helping the management in taking future decisions. So, by that, now you have got a clear idea of what are the kinds of roles that a management accountant is supposed to be doing in a company. So, if you are all good at these kind of roles, you will be a really good management accountant. So now that you have understood the roles or the responsibilities or the kind of work that the management accountant is supposed to do, now we are going to understand the difference between management accounting and financial accounting. Now, we are having this topic because many people have a different assumption that management accounting, financial accounting, and cost accounting are the same thing, just a few small differences. So, now we are going to bust these confusions between the people to understand what are the clear differences between management accounting and financial accounting. So now here I have actually made the differences based on a certain categories. So I have made differences based on the users, the objective, the event focus, the legal slash the rules, the information, planning and control. So now the first column on the right is the management accounting and the second one is the financial accounting. Now let's start off with the differences between each of them. Now, based on the users, management accounting, it's showing internal and financial accounting, it's showing internal and external. Now, we are going to be differentiating these two parallelly, okay? So, internal users means that a management accountant actually reports to the internal management or the owners of the company, right? And these reports or the data or financial data or the quantitative and qualitative data that is being done by the management accountant is actually used by the internal committee of inside the company and it's not published in any website to for the investors or something like that. So it's all the data that is done, all the analysis, the data or the forecasting done by a management accountant stays internally inside the company. Now, talking about financial accounting, the financial accountants, all the data like the financial statements, whatever data that is being done or created by the financial accountant is actually used by both internal users and external users. So basically, internal users remains the same. The internal committee, the owners or the management, upper management, people above sitting in the hierarchy, above in the hierarchy. Now, external. What do you mean by external users? So external users are the investors or the people who are willing to invest into companies. So on what basis are they going to invest? So these investors will actually look into the balance sheet, the financial records of the company to actually understand whether this company is financially stable, whether this is a debt making company, whether the company's fundamentals are strong, or whether they are making losses this year or this quarter. So that's how the reports or the financial data provided by a financial accountant is both used internally and externally. So now that you have understood the difference of management accounting and financial accounting based on users, now let's move on to the next point, that is the objective. Now, the objective under management accounting is written as assisting the internal management, and the financial accounting is written as assisting the internal and external decision makers. So, it is the same, almost same as the users. So basically, the users, as we told, is the internal management, right? So whatever, as a investor's perspective, if you actually are a good investor, you must understand that a good investor must actually think about the future of the company, right? So if he is new to investment, he must be thinking that why is a company wasting money on a management accountant and paying a lot of money to him. But if you are a really good investor, you must be actually grateful to the company that the company is actually having a management accountant which is actually helping the management in assisting the future plans of the company, right? So the objective is assisting the internal management. So a management accountant actually forecasts different kinds of data, which actually helps the management to make future decisions regarding the future expansions, etc. And the management accountant also show alternate course of action. What are the benefits of this course of action, and what are the benefits in this? What are the pros and cons of each course of action which they choose? So that's how the management accountant is assisting the internal management. Now, assisting internal and external decision makers. Now, financial accounting, the financial data is provided to internal management, and it's always a quantitative way of presenting the data. Now, the external decision makers are the investors. So basically, by providing the financial data, statements of the company. The external decision makers are the investors who would like to invest in this company, with, looking into the financial, because the balance sheet of a company is a very promising piece of paper that actually helps the company, or the hence the investor, understand the companies is doing well, and in a long term basis he is going to provide a lot of profits and returns to the investor. So that's how it assists the external decision makers to actually invest in this company or not. Now, coming to the third different point of focus, that is event focus. So, in management accounting, it is written the future and present events, and in financial accounting, it's written past events. So, what do you mean by event focus? So, based on event focus, I meant that the management accountant basically works for the future expansion or future planning of the company, right? And the financial accountant actually works on the past events or the past records or the transactions that has already happened, and what is the condition of the company now, right? So that is what I meant by event focus. So a management accountant actually forecasts the budget, forecasts then formulates the planning by actually understanding how much financially stable we are, and what are the course of financial expansions that a company can take in the future. So his observation is towards the future, and a financial accountant is basically working on the past events. So all the works he does is based on the past that has already taken place. So whatever transaction that is taken place, he's doing the accounting, and then the all balance sheet and credit trial balance and credit and balance should be equal, all these kinds of things, and the financial statements, the balance trading account, the balance sheet, all this is the past account, right? So that is what I meant by event focus. So this is a major difference, because management accountant is future and present oriented, and financial accountant is past oriented. Now coming to the fourth point, that is legal slash rules. Now under management accounting, adhere to the rules under the management and adhere to the rules under the financial body. The financial body here is ICAI, that is Institute of Chartered Accountants of India. Now, adhere to the under the rules of management. So management accounting is not actually should not follow any rules that is under ICAI, because he is actually working under the management, and he must just follow the rules that is full rules and instructions that is actually given by the company or the upper management. Now coming to financial accounting, there is always a financial body in that country that actually puts up the rules that must be followed in the financial accountings. So the financial account must always obey and abide by the rules in while making the financial data. Now coming to the information. Now management accountant actually provides both quantitative and qualitative information to the management, and financial accounting is always quantitative. Now financial accounting, from the past data, it actually finds out the quantitative measures, how much amount, profit and loss, the income, revenue, all these kinds are quantitative measures, and understands how well the company is doing in the measures of numbers, right? So we can understand how much loss or how much profit is the company making. Now this data is actually used by the management accountant, and he finds the quantitative measure with his quantitative analysis. Now, after this quantitative analysis, he does a qualitative analysis about the forecasting or the formulation of plans, and then he works on how much of amount that will be actually required for the expansion or the course of action into new businesses, right, for the company. So that's the qualitative analysis that the management accounting does. So that's one thing, one major difference, that management accounting works only on quantitative, management accounting works on both quantitative and qualitative, and financial accounting works on only quantitative data. Now coming to the last difference, that is planning and control. Okay, so under management accounting it's written managerial decision making, and under financial accounting it's written as investment decisions. So what is the perfect difference in this is that management accountant actually makes it very easy for the management to make decision about the future expansion. That is what is actually meant for planning and control, that the management accountant assists the planning and the control of the decisions that is going to be taken inside the upper hierarchy of people who takes the decision for the company. So that's how the managerial decision making comes into play. Now, investment decisions, as I told you, the investors actually look into the financial data that has been published on the websites of the company regarding their financial stability, and then these decisions are actually made on the financial reports that is being published. So that's why the planning and controlling in this case is given to the investments or investors. So that's why it is written as investment decisions. So the planning and control goes to the investment decisions. So now that you have understood clearly, based on the different categories that I have given to you, you might have understood what are the differences actually that comes into play while talking about management accounting and financial accounting. All right, guys. So now that we had a clear differentiation between management accounting and financial accounting, now we are going to remove all the confusions between the differences of management accounting and cost accounting. Now, you might hear some similar points that I'll be telling about management accounting, which were discussed earlier, but there are the difference on the category of difference that I have made here is a little bit different because I have made the differences based on objective, nature, guiding principle, legal slash rules, and the data used. Okay, so let's start off the differences between these two. So, starting with this, the objective. Now, under management accounting, it's written like providing information for planning, controlling, and decision making. And under cost accounting, it's written to determine the cost of production. Now, management accounting is done because providing informations for planning, controlling, and decision making because a management accountant actually creates reports and assists and formulates or forecasts the different plans that is going to help the inner or upper hierarchy of management to make the decisions for the future expansion of the company. So that's how the management accountant creates the reports to the internal managements and thereby fulfilling the objective of planning, controlling, and decision making. Now, talking about the cost accounting, it's basically accounts to determine the cost of production. So, if you are actually creating a product, there will be a cost that is coming from the raw materials, then the cost of operations, the cost of production. So, these are the kinds of costs that will be actually accumulating and finally determining the cost of production of that product. So that's what actually cost accounting does. Now, coming to the second point, that is nature. So, the nature of management accounting is basically into planning and decision making on future programs. So, as we discussed earlier, the management accountant is basically future oriented. And when coming to cost accounting, similarly to financial accounting, it is based on the past performances or records or transactions and present financial figures. So that's the kind of nature that the management accountant works accounting does and the nature the cost accounting is. Now coming to the guiding principle. So there is no general principle that is coming for the management accounting, but there is a principle of cost concept that comes into cost accounting. Now coming to legal rules. So as earlier, management accounting is adhered to the rules under the management or the rules or policies or company policies that he's working in. But cost accounting is adhered to the rules of the financial body. For example, in India, it's ICAI, that is Institute of Chartered Accountants of India. So that is the kinds of rules that the cost accounting is adhered to. Now, coming to the data use. Now, the data used by management accounting can be both quantitative and qualitative, but cost accounting is purely quantitative aspect of because in data use or it can also be information that is provided by management accounting is both quantitative and qualitative. He works upon quantitative and qualitative data and also provides quantitative and qualitative data that we discussed in earlier difference. Now here regarding the cost accounting, it's always the quantitative aspect because it's always the number, the cost of production, the cost, the debt, everything is the amount of money that is being spent, right? So it's always the quantitative aspect that is getting talked in the cost accounting. So by that, now you have understood what are the clear differences between management accounting and cost accounting. And earlier we discussed about the management accounting and financial accounting. So now you might have a clear idea and the differences between all these three. All right, guys. So now that you have understood the differences in the accounting terms that were discussed, let us discuss real-time example and come to know the approach of managerial accountant in the company. So now Rohan is the CFO of a manufacturing company, and the company's controllers has asked him to submit a quarterly review. Now here what we have to understand is the approach that he has taken. So Rohan, as the CFO of the company, actually is obliged to put in management accounting report to the upper hierarchy. So the first and foremost thing that he did to in his report was adding the company's financial to the report. Now that was not difficult for Rohan as there was a precedent on that. Now, coming to the next important decision that Rohan must choose is that the important variables. Now, since he was in line with the business areas that the company was following, he must choose the right business variable onto his report. Now, the two different business operations that the company was working on was the online commerce and a very big, large client that recently signed. So now Rohan, instead of adding the analysis of the website or the deals that were taken place with this big client, he actually put down the operations that actually affected the company's finances. And then he submitted this report. So he only used that report that which had an impact on the company's finances with new business operations into his report and finally submitted to the board of directors. Now, when the meeting with the board of directors came in, the board of directors actually loved the report that was presented by Rohan to them because it was clearly mentioning what are the effect of these two new business operations that is taking place on the company's finances, and they are on as a matter of fact they actually put on other resources. They allocate other resources to find out answers to the questions that was not related to finance. So this is how the approach of a management accountant actually plays an important role in the company. So now that you have understood this approach from the case study that I have been given to you, now you must understand what kind of approach must be taken as to pursue a career in management accounting. Now let's move ahead with the next topic where we'll be discussing what are the kinds of topics or the subjects that were discussed. That is the summary. All right, guys. So now we have reached the summary part of this course. So here we'll be just discussing about what are the topics that were discussed in the entire course. So to start off with, we discussed the basics of accounting. So we actually brushed up the topics of basics of accounting, and then we actually moved on to the first major topic of our discussion, that was what is management accounting. So in basics of accounting, we actually had to discuss the account process of accounting. Then we understood the five elements of financial statements. So these were actually very much required to understand the concept of management accounting. Then the second topic was the start of our major topic, that is what is management accounting, where we had a proper definition to what is understood by management accounting. Then to make the things even more clear, we had characteristics or the nature of management accounting, wherein we got to know even more what management accounting is. Then if you are actually really interested in to pursue a career into management accounting, we had the fourth point wherein we discuss the role of a management accountant, wherein we discuss the actual day-to-day roles of management accountant and what kinds of responsibilities would have been fallen onto the management accountant in a company. Then in the fifth topic, we discussed upon the differences between management accounting and financial accounting. And similarly, in the sixth topic, we discussed the differences between the management accounting and cost accounting. So by these differences, we could actually differentiate and understand that these three different accounting terms were actually different, and we could actually remove the confusions of assuming that these three were the same. Then finally, we got a chance to conclude the part by actually understanding the approach of a management accountant in a company that was actually a manufacturing company, and the way he used the strategic way to attack his management accounting. So that all were the topics that were discussed in this course. I hope you guys have enjoyed it, and I believe that you guys have got a good idea of what management accounting is. And if you guys are actually interested into doing management accounting, there are good courses like SEMA and SEMA, that is Started Institute of Management Accounting. So these kind of courses would actually help you to become a proper management accountant. So now that's all from my side. I hope you guys have enjoyed this course. Now, thank you for watching this course till the end. Now, we'll be seeing you guys with another one very soon. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out any new updates or video releases from Great Learning. If you enjoy this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any queries or suggestions, and I will respond to your comments.